Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, listener, and thank you for joining us today. Markets have remained under slight pressure over the past week, with both equities and bonds falling, while commodities rose and the dollar strengthened. Today, I have with me Rajat Bhattacharya, who runs our economics team, and we will discuss the potential market catalysts going forward. So topics of conversation today include inflation, monetary policy settings, the US earnings season, and obviously the likely implications for US, European, and Asian equity markets. So Rajat, thanks for joining me today. I guess the backdrop of today's discussion is that after rallying strongly in the second half of March, global equities have faltered in the past couple of weeks, so failing to break above that February high. And short-term technical charts suggesting that we're likely to see a sideways trend, at least for now. Obviously, 10-year government bond yield in the States have continued to rise. Of course, we can argue that's a positive in terms of the economic growth concerns may be easing. And finally, the dollar index has broken above 100, which was certainly outside of our expectations, and that's to a two-year high. And that's obviously on the back of surging Fed rate hike expectations. So that's a history lesson. I guess the question is, where do we go from here? So what are the key factors or catalysts that you're keeping an eye on to try and figure this out?
Morning, Steve. Glad to be here. The first on our radar really is the upcoming US Q1 earnings season, which just started this week. So US earnings have consistently beaten market expectations every quarter since Q4 2020, turning into a fundamental driver of the equity bull run since the post-pandemic recovery. This time, though, the bar is low for earnings beats, really, with the consensus expecting only 6.1% growth in Q1. But if you exclude the energy sector, which is benefiting from the surge in crude oil prices, expectations are for flat earnings, really. With the consensus also expecting 11% revenue growth, the market is clearly concerned about rising wages and raw material costs eating into corporate profitability. Thus, we would closely watch the forward-looking management guidance on profit margins this year as well.
Yeah, so I suppose inflation obviously is a major concern for everybody, and that's from a policy perspective, which we'll talk about in a moment. But how does inflation affect corporate profits?
Yes, certainly. Inflation and its various drivers are likely to be critical for corporate profits. This week, for instance, the US data showed headline inflation surging to a new 40-year high of 8.5%. And these are the levels we haven't seen for decades. As we said, it's a 40-year high, driven by energy and food prices, as the Ukraine war has started to make its impact felt. So there is a risk that these prices filter into other sectors, keeping inflation higher for longer. However, when we look under the hood, core inflation has started to decelerate, falling below consensus expectations. The pandemic-driven drivers of goods inflation are starting to fade. For example, the prices of used cars and trucks fell almost 4% month on month in March. Meanwhile, the services sector inflation, including shelter, airline tickets, and medical care, have started to pick up as the economy gradually reopens. The service sector inflation is actually a good sign. It shows companies are being able to pass on higher costs to the consumers. Since the services sector accounts for three-fourths of the US economy, this is likely positive for US corporate profits and by extension equities, we think.
Yeah, so I suppose the picture you're painting is one where inflation stays high. It may ease a bit, but it still remains high. So obviously that leads to another concern of investors is the tightening in monetary policies. Is this a concern from your side?
Yeah, the above scenario would of course keep the Fed hawkish, as we heard from several Fed speakers this week. Before an inflation peak leads to a softening of policy stance in the second half of the year. Markets are already pricing around 240 basis points of Fed rate hikes over the next 12 months, which is a lot. I mean, that indicates that inflation risks have been substantially priced in. So, given that, I mean, the way we look at it is that for now in bonds, the 5 to 7 years maturity bucket would be the prudent place to be in.
Okay, let's move away from the US and look elsewhere. So obviously Europe has been going through a difficult time. I mean, that's part of the reason why the dollar strengthened, because the euro has been so weak. But maybe, what do you think of the outlook for Europe going forward?
In Europe, clearly, Steve, the main thing is the war in Ukraine. This is a key catalyst for markets. Russia's President Putin vowed this week to continue with the war, raising risks that more sanctions from Europe could come soon, including, crucially, we need to watch that one on Russia's energy exports. Euro area growth expectations fell this month to their lowest since the depth of the pandemic. This puts the ECB in a tight spot as it meets today, with inflation surging to a record high. We really expect the ECB to continue unwinding its bond purchases for now, as it focuses on subduing inflation while awaiting more growth data. It also is due to come up with its new forecasts in June. Meanwhile, in France, the presidential election runoff there is another major focus, with polls pointing to a tight race between Macron and Le Pen. So a Macron win would, of course, be positive catalyst for euro area assets, as it would help bolster region-wide investment in defense, in nuclear energy in France, for example, and green energy infrastructure. Meanwhile, in China, the focus remains on the COVID-19 lockdowns, but there are signs of that easing because they have eased its restrictions in Shanghai, for instance.
Yeah, maybe actually let's move to that then. I mean, Asia, has been under pressure, but I believe you're a little bit more constructive on the outlook for Asia. So maybe give us a quick rationale as to why you're looking a little bit more positively there.
Sure, sure. But against the backdrop I just painted, I mean, the outlook for Asia and Japan really stands out. If you ask me, in China, as I said, the COVID-19 restrictions in Shanghai and some other cities are easing, so that's a positive sign. This week we got data from on credit growth, which is a key driver of the Chinese economy and markets there. The credit cycle is turning there, and the stronger than expected credit growth in March is being driven by government borrowing, which is being used to fund infrastructure. So this is positive for a sustained growth recovery as China turns around. This is very different from what we're seeing in some of the Western countries. With attractive equity valuations compared with the US and Europe, we would continue to add exposure to Asia ex Japan, including in China, in such an environment. I mean, if you want to rebalance, you could rebalance from US and Euro area equities if those exposures are above benchmark. We would also continue to add, of course, to gold. Gold is now heading towards that $2,000 mark. And of course, energy and commodity-based assets and private real estate continue to be good hedges against any stagflation risks.
Yeah, and I guess the dollar outlook is going to be pretty critical to how this is going to play out. So obviously a weaker dollar, which we still expect to come through ultimately, would be positive for EM assets in Asia in particular, and obviously for some of the other assets you mentioned as well. Okay, well, Rajat, that's all we've got time for today. It's really been great chatting with you. And thank you all for listening in to us. I hope you will look forward to connecting with us next week. Obviously, Manpreet's Daily Cut to the Chase series will continue on Monday. Meanwhile, please look out for us on LinkedIn via our SC Wealth Insights page, where we share our thoughts and publications on a daily basis. As always, feel free to subscribe and like our podcast series. Please take care and stay safe.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.